Hello, everybody. So we finally got HIMSS Q1 2023 earnings. This is what I've been waiting for, what I think a lot of us investors have been waiting for. We love HIMSS. It's a great stock, and they did so well just now. So well. So subscribers are up 87%. That's good. That's a strategic metric. But revenue is up 88% year over year. And this is a major beat. Remember, they had guided for this Q1, so 3 months ago, when they reported Q4, they had guided for 75%, and they achieved 88%. So that's a major beat and a major delta to the upside. Let me just go through really quickly through the different metrics. So first of all, I want to focus on the strategic metric of subscribers. So the subscribers are up 87% year over year, but look at the quarterly growth. And you know, on this channel, I look a lot at Q over Q, quarter over quarter, because I want to make sure there's no deceleration. A lot of businesses are still showing great numbers because of easy comps, but quarter over quarter numbers don't lie. So when you look at quarter over quarter, that growth, when you divide these numbers, that growth was 16.25% growth quarter over quarter. And if you annualize that at the rate of Q1, right? So you take this number and you annualize it for Q1, that's an 83% annualized growth rate at T equals Q1. So that's absolutely wonderful. The real run rate is not even changing that much. So that's really outstanding here. What this means is that the Q over Q number of 16% and 83% annualized, what does it mean? There is no meaningful slowdown that you can read into that. This is within the margin of error. The marketing is effective, right? They're selling a lot more. They're spending on marketing. They're selling a lot more. Customer retention is effective. You don't get this level of growth over so many years without having an effective customer retention tactic. And their claims, and this is what they say all the time, but of course it's true here, their claim that there will be a bunch of cross-selling is true. These numbers don't deny that cross-selling is going to clearly happen. They are not seeing the slowdown that a lot of companies are seeing, and that's probably because of product. The product is highly defensive. People are not going to stop taking ED drugs or taking, air loss drugs. They're not going to stop doing that because there's a recession. And this is showing really well in the strategic numbers. So the customer growth are really strong. And that, right, in the revenue, when you look at the revenue, you see those numbers really getting translated in the revenue, because in the revenue, you got 14% quarter over quarter growth. So 80% year over year, but 14% quarter over quarter. This is outstanding. Annualized, this is 71% at TQ1 annualized. So what can I say? There is a meaningful conversion between the new customers and new subscriber gains into actual tangible revenue. There's a meaningful translation of the strategic progress of this company into financial progress, and that translation almost happens in real time. Also, there is a deceleration here, a slight deceleration, right? 88% compared to 71% annualized. So, of course, all businesses start hitting the law of large numbers, but that deceleration is not at full steam whatsoever. This company has just begun the little bit of that curve of deceleration that you get from the law of large numbers. Not that much. I mean, to give you a comparison, for example, Snowflake, a stock that I really got mad at, that I used to like, but Snowflake's growth got halved in a matter of 12 months, right? We are not seeing a halving of that growth, right? We're seeing a growth rate going from 88% to the 70-ish% rate. So clearly the slowdown when you see, and the law of large number slowdown, when you see in a lot of, say, tech industries, traditional tech industries or SaaS industries, you're not seeing for this stock, which to me is absolutely outstanding. So good job, HIMSS, and I'm gonna be selling some stock to buy some more HIMSS right now, because the market is really not rewarding this stock like it should. I believe this stock should be up 30% on this news, but we are very lucky that the stock is down 10%. Anyways, moving on, let's look at positive adjusted EBITDA. So for a company like HIMS that has essentially no debt. I mean, they have leases, but they have no debt. For a company like HIMS, that's a good proxy for cash flow, and it's going up. And so Wall Street somewhat likes to see that, because they're like, okay, well, as this is going up, it means we're going to have real earnings someday. As you know, I don't want this stock to show earnings yet. I wanted to keep reintroducing money into the business, putting more money into the business, right? This is the time to grow aggressively while everybody else is scaling back their spending. But all I care about this is that it's above zero. So as long as it's above zero, and as you know, they have 180 million in cash, no debt. 180 million in cash, and it's above zero, which means that you have a runway to bankruptcy of infinity, which means that they are not at risk of bankruptcy at all, which is the only thing you got to make sure when you invest in a growth stock is that really the business is not headed towards bankruptcy. Absolutely not the case. They have $180 million in cash, and if they don't spend that cash from their adjusted EBITDA, if they don't spend it, this is going to accumulate. So I'm hoping they spend it, but there's a lot of evidence that this is a company that is spending for its growth, and it makes sense for a company like HIMS. This company is growing really fast. Now, HIMS, what else can I say? It is the sandbagging king, or the sandbag king. Sandbag King. I love that about HIMS. So you may remember D-Dog. I don't know if you follow Datadog, which is another stock I cover on the channel. I called them out for sandbagging 4 months ago, and turns out they weren't sandbagging at all, right? They guided a huge deceleration in their growth, and that deceleration happened. So they're not even part of what I'm gonna call the sandbagging aristocracy. They're not even part of that. HIMS is the king of sandbagging. Like this is absolutely insane. Right? They're still guiding 54 to 58. So let's call it 56% growth. They're still guiding 56% growth, which, by the way, if you look at what they guided last quarter at Q4, they had to increase this. So at Q4, they were at 41% growth for full year 2022. They had to increase it to 56%, right? This quarter. So in 3 months, they had to do a major up delta. They had to increase it double digits. And my guess is they're going to have to increase it double digit again, because one needs to explain to me, when you are guiding year-over-year growth for Q2 of 76 to 81%, which, by the way, if you remember, they achieved 88% here, and they had guided 75. So this is likely sandbag too. So one needs to explain to me how you get to only 54% growth with those numbers. You know, businesses have inertia. This is a business that has inertia. It's not like you can stall the business this fast. I think they will be above that 54 to 58%. You know, so again, someone needs to explain to me the sandbag, because if you do the calculation, you realize that you need actually even lower. You need lower than 50% in Q2, which we are not guiding. You'd need 50% in Q3, which we are not guiding yet. So this would need to be a huge miss in Q1, in Q2. You'd need to have a huge miss in Q3, and then you would need to have a mind-boggling miss in Q4. You'd need 30% in Q4 to get to that annualized number, roughly, back of a napkin. So that annualized number is extremely low. This is a business that has a run rate right now, a annualized rate at 71%, of course. So anyways, I don't buy that at all. They are the sandbag king. Good for HIMS. They're setting themselves up for positive surprises, and thank goodness they are doing that, because imagine if we didn't have that positive surprise right now, the stock would be down 30%. It's down 10% despite absolutely wonderful numbers. I cannot understand that. And by the way, if you want to compare both of these charts, let me pull it up so you can pause the video. This is what they had guided in Q4 2022, reported in February. This is what they guided in Q1 2023, reported yesterday in May of 2023. So you can see everything's up compared to their prior guide. King of sandbagging. Good for HIMS. And we understand that I think these numbers are going to be much higher going forward. We understand because And let me go quickly. I'll make over videos about the product. There will be over videos about all the products, and I'm going to listen to the conference call, make a video on the conference call, etc., etc., etc. Very busy right now. I haven't had a chance to listen to the call, unfortunately. But there's multiple levers for growth. First of all, you have HIMS. HIMS will see more growth. There will be growth from him from what I call new adoptions. So a new customer and a new sell. That's a new adoption. But there's also old new adoptions, or what I call cross-selling in that case. So that's, for example, because we know that a lot of the minor health problems that HIMS addresses are highly correlated. So, for example, you have an air loss customer who may getting air loss in year 1, and then they realize, okay, I'm going to get ED drugs now in year 2, and that's how you do all cross-sells, or vice versa, right? Could go any way. But a lot of the minor issues that say men get in their 40s, they tend to be highly correlated, which leads to a lot of cross-selling for HIMS. Then, that's area number 1 for growth. Area number 2 for growth is the HERS platform, and this is the expanding to the other gender strategy is a tried and true strategy, right? This is as old as the world of business is old, right? That's one example why Harley Davidson motorcycles, for example, is trying really hard to sell Harley Davidson motorcycles to women, because they realize they would double their sales. Right? This is the same reason why Lululemon is trying to sell clothes to men, because they realize they would double their sales. So HIMS is doing the same thing with HERS. They launch HERS later than HIMS, right? The business got started with HIMS. That's why the ticker symbol and the name of the company is still HIMS. But now they're doing HERS, and they're launching a bunch of products of HERS, and that would be things like UTI, yeast infections, migraines, collagen treatments, birth control, depression. Although depression is a product that they sell for men as well. Obviously, these products you don't sell to men, obviously. Aside from migraine, but moving on, there's a third aspect to this, which is they're developing a whole bunch of new products that can apply to both men and women. So what are these products? So obviously, anxiety, depression, these and anything that has to do with mental health. These products are products that you leverage in both platforms, in HIMS and HERS. You leverage that, right? Anything that has to do with dermatology, eczema, rosacea. These are all issues that apply both equally to men and women. So you develop a new product pipeline, and then you market it, right, for your different brands. You're marketing for HERS and you market it for HIMS. That's what you do. And then they have over market, like pain management, for fertility. That would be anyways, you have fertility, weight, cardio, diabetes, all of these issues. They can market mostly to both of them. Some of them only to women, some of them only to men. But you see where I'm headed here. There's a lot of new products out here coming, and the total addressable market in the US, you see 80 million, 50 million, 100 million. So this company has a tremendous potential for exponential growth, not just linear, exponential. I believe this is a company that could become the premium brand for preventative healthcare in the US. They have a blue ocean. There's few brands in healthcare. They're competing against names of conglomerates that don't mean much. This is a company that's developing a brand. Very, very powerful stuff, I believe. And good news, HIMS is the cheapest stock again in my universe, because when you update all of this, right? So you update enterprise value, right? I did that because the stock went way down. Let me show you the stock chart. The stock over 2 days is down 11%. So I had to update that way down. Enterprise value is way down. Revenue is way up. The growth, they've guided new growth, 56%. So I'm updating this, right? But look at this, and this is even better. The gross margin of HIMS is up. I didn't see this discussed as much on Twitter. This is a big deal. They moved the gross margin to 80%. So we are like, we were already in the SaaS software type margin. We are now moving into the better than SaaS, or like better type of SaaS margin. Like, this is absolutely outstanding at 80% margin. So this is really, really great. And if you look at, and you know, my metric that I use on this channel, my preferred one is enterprise value over gross profit over revenue growth, which asks this question: how much am I paying for each percentage point of forward growth? how expensive is each percentage point of forward growth. And HIMS is the cheapest in my universe. I consider anything under a 0.5 to be good. And it's right about the average of all of the stocks that I follow on the channel. This one is way, way, way below. And we have so much more going on. We have long-term guidance until 2025, which is sandbagged too. I mean, this is a stunning company. I love this company very much. I will buy more of this company today. And I will conclude with this. One of the reasons I believe why HIMS keeps growing while other stocks are not growing as fast right now is because HIMS is doing strategy. HIMS is not doing finance. We are not following the Wall Street demands. That's what I think is very powerful for HIMS, because when you see, that's why I say, sorry Wall Street, but marketing is an investment. When a company has 85% customer retention after 2 years, and remember, this company was founded in 2017, so it's not like we have, too much of a look back. Retention is likely much higher than that. Like, you sign up a customer, the customer may stay with you for 10 years, except you can't know that because the company is not 10 years old. Anyways, so you have 85% customer retention. Obviously, when 85% customer retention after 2 years for your customers, when 95% of your sales are recurring, this is obviously a wonderful investment to invest in marketing. And I am glad that Wall Street is investing in marketing, and their booking is an expense, because GAAP makes total sense, right? Is this really an expense? I don't think so. It's not an expense. This is very, very wise for HIMS to invest in marketing right now, and I love to see that, and I love that we're not caving into Wall Street, showing earnings. As long as they have positive free cash flow, that is all I care. Grow, grow, grow. And that was HIMS is doing, and I'm happy HIMS is doing that. And I am now going to study my portfolio and see what stocks I can sell to buy more HIMS. And I will be making at least 2 more videos on HIMS this upcoming week, but very, very, very busy right now. And I'm hoping to be able to listen to this conference call this afternoon. I can't wait. Thank you so much for watching. This is not investment advice. This is entertainment only. I hope you were entertained. Appreciate all of your likes. Appreciate all of your subscribes. Have a wonderful day.